Business owners who want to maximise their outcomes when selling their businesses need to understand the motivations of prospective buyers across different categories. In this video series, we're covering the different categories of buyers and their motivations. In other videos, we've covered buyer job market buyers, private investors, and private corporations. In this video, we'll look at the motivations of private equity funds towards making acquisitions. Now let's look at private equity funds. A small portion of the billions of dollars invested in superannuation funds or pension funds is allocated to institutional private equity funds to pursue high growth business opportunities. Private equity investors have specific ranges of business sizes they're able to acquire, usually at the larger end, and the larger the better, as their transaction costs are generally high, particularly because they outsource all of their due diligence, and that's mainly because of their high accountability to their investors. They're represented by the red line on this chart. It would be rare for a private equity fund to acquire a business worth less than, say, $3 million. Private equity funds understand the leverage mechanisms involved between the private and public companies, often positioning themselves in the sweet spot right between the two. Private equity funds can access funds and become industry consolidators in much the same way as a public company can. Many are very good at making acquisitions of private companies in a target industry, combining or consolidating them into a larger group, installing competent management and infrastructure, running them for a few years and then exiting through either an IPO or a trade sale. Many work to a time frame of 3 to 5 years for such an industry play. The businesses they buy and ultimately sell are really commodities to them. They're tradable assets that can be grown quickly, and then they make themselves and their investors a lot of money quickly. And if a business owner sells into a private equity firm, they may have the option of retaining some shares or taking out some shares in the expanded business, and in many cases, if it goes well, they can make as much money on, say, the last 20% of the business that they retained when they sell it as they have done on the previous, say, 80%. Private equity firms are run by very capable business people as a rule. If the strategy is right and it's executed skillfully, the returns to these firms and their investors are often astounding. Typical private equity fund will look for investment opportunities with a good team, proven scalable business model, it's in a growth industry, the financials say revenues over 5 million, EBIT over $1 million, the ability to grow revenues to greater than 50 million in 3 to 5 years, either through this business or other bolt-on acquisitions. They also need to identify before they go in how they're going to exit again, whether it be through a trade sale or an IPO. Either way, they need to know how they're going to get out before they are comfortable going in. I hope you found this video useful. If so, please give it a thumbs up and join us with the rest of the video series.